what's more important than it specifically being gold or silver or Bitcoin is the principle of monetary freedom.
Are you tired of overpaying for your gold, silver, and platinum bullion coins and bars? Then visit sdbullion.com today. SD Bullion was recently named the 177th fastest growing company in the United States by Inc. magazine. This is because they offer the absolute lowest prices in the industry and follow up with over-the-top customer service. So what are you waiting for? Go to sdbullion.com today and join more than 60,000 happy investors that save money on every precious metals purchase they make.
Hey everyone, this is Elijah Johnson with SilverDoctors.com, and with us today a new guest, Dr. Richard M. Ebeling, BB&T Distinguished Professor of Ethics and Free Enterprise Leadership at the Citadel in Charleston, South Carolina. Dr. Ebeling, thank you so much for joining us today.
My pleasure to be with you. Thanks for having me on.
All right, now the first topic I'd like to discuss is about the Federal Reserve. Now this is kind of a broad topic, but really it has to do with the Austrian School of Economics, because one of the things, and you're expert on Austrian school, one of the things about the Federal Reserve is that it's really, in a way, like a pseudo-government agency that controls monetary policy. And in Austrian economics, one of the big aspects of it is that really monetary policy should not be controlled by the government. Is that true?
Yes. The core premise is that government does not need to be and should not be in charge of the provision of the supplying of money. The Austrians, beginning with its founder, Karl Menger, in the late 19th century, emphasized that money, in fact, is a product of the government, of the market itself. It emerged out of the discovery of people that there were difficulties with barter, the trading of one good for another. What if you have what I want, but I don't have what you want? Well, how are we going to consummate an acceptable trade? So slowly but surely, going back in the midst of time, people would scratch their head and say, well, rather than leave this little arena of exchange frustrated, perhaps I could trade what I've produced, which someone else wants, and I can get from them some commodity that I may personally not have a use for, but which that other person, whose good I really would like to have in exchange, will take and trade with me. And therefore that commodity, which I bought by selling my good and then using it merely to trade away again for that which I really desire from the relevant person, is a medium of exchange. Now, again, through a long process of several generations of peoples who discovered this, it was found that there are certain goods and services, goods in particular, that have high demand, useful and particularly durable qualities and characteristics, and these became the generally used medium of exchange. And that is the definition of money, the most widely used and generally accepted medium of exchange. And historically, that was gold and silver. Other things have been used as money through the ages: bronze, copper, in the Americas, tobacco in the early colonial period, and so on. But gold and silver were the commodities that, because of their intrinsic qualities and features and characteristics, people found to be most useful. Then people found it was difficult to carry around gold and silver. It's bulky, even though it's less bulky and inconvenient compared to other things. And you could be waylaid by a bad person who might want to rob you. So in a long story that's be too long, there emerged banking depositories. You deposit your money, your gold and silver, and you'd receive a warehouse receipt, a slip, a ticket representing your claim to it. And then you could go and get your gold and silver out of this protective depository at any time. But again, to save you, the people, the transaction costs of going back and forth, just to then carrying out trades, if these depositories, which were really the emerging forms of banks, had a reputation, a high reliability, a respectability within a community, then people in trade would would be willing to accept these receipts, these warehouse receipts, these claims to the gold as payment, knowing that they themselves could go there during, quote, normal business hours at any time and get the gold or silver that had been, the title of which had been transferred to them by selling someone else some good or service. And that's basically, in a very crude and brief and thumbnail version, the origin of money in banking. And all of this could go on fine without government. But again, in a long story, governments want more wealth than they can always extract by taxing us, because eventually people will try to evade the law, or they try to overthrow the greedy and selfish king who keeps grasping more of what they've honestly produced. So governments started taking over the coinage of money, and they would start debasing the coins by putting in less gold or silver content in the coins themselves than were actually embossed on the face of it. You're deceiving the coin holder. And they started doing the same thing with banks. Banks would make loans to the government by printing more of these claims, these issues, these banknotes. And then the government would spend them and cause rising prices, debasement of the currency, price inflation. And our central bank, which is the Federal Reserve, is just one variation on this. As you were saying, it's a government-created institution. In 1913, it was created as a private institution chartered by the Congress to be responsible for two general domains. One, to control the quantity and the value of the currency. Basically, the central bank, the Federal Reserve, now became the monopoly issuer of money. And to, in some general sense, that's become more detailed and specific over the decades, to oversee and manage the banking system, to see that banks are operating, quote, honestly or by the Federal Reserve rules and restrictions and so on. And that has been but what has happened to this is that how much money should be in the economy? When it was market-based, if people had a greater demand for money, the old-fashioned gold and silver money, then it would become profitable to mine more gold or silver. Prospectors would go out, they attempt to find pockets of gold and silver, they would extract it out of the ground. Part of it would be used for industrial or ornamental or commercial uses, but others would be minted into the coins and the bullion, which would then be deposited at banks for convenience by the private owners. And as more gold and silver came onto the market, its value would tend to depreciate. Its price would go down. Prices would start to rise, and then it would become, after a while, less attractive to keep mining and minting gold. And there'd be sort of a balance, an equilibrium between the supply of it through mining it and the demand for it for monetary and other purposes. But now the central bank took over. Well, how much money should be in the economy? And this becomes based upon the hubris and arrogance, in my humble opinion, of those who manage it. Well, we know what is in the national interest. We know what would be economically beneficial. We know how the amount needed to stimulate more output or growth in gross domestic product or to assure full employment. So it becomes micromanaged by the central bank in a macro effect on the society. And at the same time, governments, including in the past the U.S. government, has pressured central banks to basically provide the amount of money needed to fund spending that the government undertakes in excess of what it takes in taxes. In other words, central banks have printed up money, often to basically subsidize and provide the necessary monetary means to cover the cost of a budget deficit. And that has been the case in the United States and notoriously in many other countries. So we have all of these situations of monetary debasement, no rationality to the supply and demand for money, waves of inflations and recessions, and the arrogance of central banks and their managers believing that they know what interest rates should be. That is the price of borrowing and lending. Like any other price, the price of hats, shoes, bananas. This should be set by the market based upon the interaction of people who choose to save a portion of their income rather than spend it, and those who would like to spend more than their own income would permit through borrowing purposes, perhaps to take out, undertake an investment project or a mortgage or to buy a car and so on. But the government comes in through the central bank the central bank actually itself, and it just sort of sets the interest rates at what it thinks it should be. Well, this is just like a price control. And we know notoriously what happens with price controls. If they're set above where the market would set it, it creates an unsold surplus, an inventory of unsold goods. And if it sets it too low, it creates a shortage of something that people want more of, but which they can't get. So governments' control of money through their central banks have been notoriously destabilizing, harmful, and politically manipulated. So in general, as I see it, it would be better if we could devise a way to basically do away, abolish, repeal the central banking method of managing things, and just have money and banks be private, competitive, free banking with depositors and users of money deciding what they want to use as a medium of exchange. It might be gold and silver again if it was just left free of government control. It could be platinum. It could be Bitcoin. But the point is, what's more important than it specifically being gold or silver or Bitcoin is the principle of monetary freedom. That is, the people interacting in the marketplace, finding it useful to use something as a money, should decide what particular good or narrow set of goods they find most useful themselves to use as the money commodities to facilitate their transactions and their trade through savings and investment across time. And that is the system that, again, in my humble opinion, I think we should move toward and away from what amounts to monetary central planning.
Now, as for like the stability of the economy, some people argue that before the Federal Reserve, there was a lot of booms and busts, and there weren't as many nowadays. So how, and I know this would be, your opinion is that it actually, the Federal Reserve has not helped the stability of the economy. So what are some concrete ways we can actually measure this and show that maybe the Federal Reserve has not helped?
Well, in fact, a number of studies have shown that if you compare the frequency and the severity of economic booms and busts in the 19th century. Now, we didn't have a free monetary system in the 19th century. Certainly in Europe and in a certain way here in the United States, certainly after the Civil War, we always had some forms of central banks. But in the 19th century, and certainly in the second half of the 19th century, all the, quote, major governments of the world, unquote, basically put their monetary systems on a gold standard. So as a result, though it was open to central bank management and oversight and occasional manipulation, in general, on average, taking the brushstroke view, governments were restrained by maintaining a gold standard of backing up their note currency on how much manipulation and distortion they could introduce. So there were some booms and busts of the 19th century, one or two rather severe. But if you compare the number of them, the frequency of them, and the severity of them to what has happened in the 20th century, where certainly by the 1930s, any form of gold standard was gone, in both de jure, by law, or de facto, in fact, they have been more frequent, greater amplitudes often, and more severe. We had huge inflations during and following the First World War, when governments just abandoned gold and just had paper money, both to finance the war and then things afterwards, such as the great German inflation, the great Austrian inflation. There were others at the time in the early 1920s. Then supposedly our central bank was going to manage the monetary system for price stabilization. And that itself created distortions, that is, imbalances under the supposed calmness of a stable price level that set the stage for the Great Depression, the worst economic downturn in 100 years in terms of depth and severity and length. And then you had the series of booms and busts, both in the United States and around the world in different countries, of recession, inflations and recessions throughout the 1950s into the 1960s. The highest inflation in the United States in the 1970s that America had not experienced since the American Civil War, and then a series of recessions to adjust for that. and then the dot-com bubble at the beginning of the 21st century, and now this financial crisis, as well as a mortgage crisis that we had in '08 and '09, which has been compared in its magnitude, though it's really with some exaggeration, to the Great Depression. We didn't have 25% unemployment in 2009. We didn't have output falling by 40% in 2009, as was the case in the 1930s. But in the post-war period, it was probably the most severe one. And now a situation where the Federal Reserve is continuing to manipulate the monetary system. It has created a huge amount of money, almost $4 trillion of extra reserves in the banking system, that, depending upon how the Federal Reserve micromanages that, could still set a situation for significant inflation possibly in the future, and still under the pressure to finance what is now returning now as $1 trillion a year budget deficits. And this has all been in the 20th century, when governments were, quote, liberated from gold and had the discretion and authority through their central banks to manage monetary and financial institutional affairs. And it has been far worse and far severe and far more frequent than anything from an objective point of view you could say happened during the earlier industrial period of the 19th century, and particularly in the second half of that 19th century.
Now, where are we currently in this boom-bust cycle?
That's an interesting question. Now, as you pointed out, I view myself as a member of what's called the Austrian School of Economics. Basically, everything I've said is sort of a basic Austrian conceptual and analytical framework. But one of the things the Austrians emphasize is nobody has a quantitative specific date prediction capacity. The world has, and the future has, a great degree of unpredictability and uncertainty about when, a turning point comes and the boom becomes the bust, or the bust starts becoming a boom again. But it is a case that like causes do bring about like effects in the general pattern qualitative sense. And in that sense, what as I see it, for the last 10 years, that is since the financial crash of '08, '09, and into '10, the Federal Reserve has increased, as I said, the amount of reserve lending power in the banking system by almost $4 trillion. At the same time, they have, through what they call this quantitative easing, manipulated interest rates virtually in the range of to zero in the nominal sense. Many key interest rates were barely above zero. In fact, however, when you calculate for inflation, that is using the crude but benchmark consumer price index as a measure of the degree of price inflation, for a good part of the last 10 years, the real cost of borrowing, that is the nominal rate minus the inflation, has turned out that real interest rates have been negative. That is, money has been given away in real buying terms for nothing through Federal Reserve manipulation in many lending categories, or far lower than historically has often been the case. To my mind, this means that interest rates have been false signals about how much savings is in the economy, real savings, relative to the demand for borrow. So, like in many other prior busts, savings and investment relationships have been thrown out of whack. Now, the question is, why haven't we seen more price inflation, $4 trillion of more lending power in the banks? Because Ben Bernanke, who was the Fed chairman when this financial crisis began in '08, '09, introduced an interesting trick. They buy government securities, that is the Federal Reserve, and other market assets, add to the Federal Reserve's own portfolio of these titles, supply and create all this $4 trillion, and that's supposedly adding to the capital base of the banks to stabilize them. But then the Federal Reserve is concerned that, well, we're infusing all this extra lending power, they're going to lend it, and prices are going to go through the roof. So you're stabilizing the banks, but setting the stage for a huge price inflation. So what they decided to do was to pay banks not to lend the money. So what they introduced is this quantitative easing. They create this money. It becomes a huge amount of excess lending power in the banks. And then the Federal Reserve pays the banks a little bit extra interest above what the bank could earn in lending the money to you and me, not to lend the money. Now, if you look at the little amount, it looks like a little fraction there. But when the Federal Reserve has created this much extra money in the banking system, this little fraction of extra interest that the banks get for not lending it out ends up being tens of millions, billions of dollars over a decade. So as a consequence, it's been more profitable to them sit on most of this money, actually almost $3 trillion of it, unlent to us during the decade. Now, interest rates are starting to rise through, again, Federal Reserve manipulation. And if it becomes more profitable to lend to you and me than to have the money park there and be receiving interest income from the Federal Reserve, then all that money could come out into the market, causing the price inflation that the Federal Reserve has been trying to prevent. Or they can keep manipulating this interest rate to you and me, interest rate they pay to the banks not to lend, and how that's going to play out in the particulars, that remains to be seen. But there's no doubt that underlying it all, a severe mismatching between savings and investment, misdirected capital, misallocated labor, misuse of resources has been going on under the surface. And if there is any germ of truth, correctness to this general, quote, Austrian analysis, I don't see how we will avoid a correction, a significant downturn, not just in the financial markets, but in the real economy at some point down the road. How soon? That depends upon the trickery of the Federal Reserve to try to put it off with its little magical tricks.
Now, as for the person listening, if they're not interested in, or maybe they are, taking action to actually change the system, whether that be getting involved in politics and so on, what are some ways they can concretely maybe put themselves on the other side of the situation if there is a crash coming?
That's always a $64,000 question, and I'm always a little hesitant to try to make specific recommendations. First of all, we all have imperfect knowledge, and we could all be wrong about the specific details of how the future in the concrete plays out. So I could offer advice that could turn out to be disastrous for people who might give me the benefit of the doubt and listen to what I have to say. For example, I have, for example, when in 07 and 08, my Austrian economics and my nose, if you will, told me that something was going to happen. No way to know the turning point, right? So I basically got completely out of the stock market. And at that time, I went into inflation-adjusted bonds. So when the crash came several months later, and many of my friends, I'm a professor and other professors, not just economists, but in other fields, also their retirement, accounts go down the tubes. One friend of mine, he lost like over 30% of the value of his retirement fund. I didn't lose a penny, but that's just because of the luck of the way the market was playing out, that inflation-adjusted bonds as the parking shelter turned out to be the right one. I got back into the market, but again, my timing wasn't right. Oh, it's not going to go up this as soon or as much, and so I didn't get at the bottom and ride up the roller coaster with as much success as I might have. But then it's a matter of deciding which ones to go into. All I can say is that each person should be guided by the following things. What sort of portfolio will be most likely to be minimally impacted during the downturn? What is counter-cyclical? What is likely to be less open to government influence and manipulation in the negative senses? You had asked me about Bitcoin. Now, maybe many of your viewers and listeners are great enthusiasts about Bitcoin. I don't know whether to be that enthusiastic, and I say that for the following reason. Um, I support, as I've suggested in my earlier comments, in monetary freedom. And the idea of a digital medium of exchange outside the control, management, and manipulation of government is, from a value point of view, that is a political point of view, highly attractive to me. But whether Bitcoin itself has that capacity or that investment attractiveness is uncertain yet. Its volatility, its unpredictability, whether governments will attempt to micromanage and control it in some way, it has so much haziness about it that while I like the idea and the concept and the premise from a freedom point of view, I never put it, I never doubt the willingness and ability and trickery of governments to figure out ways, at least in the short run, to manipulate things that seem like avenues of freedom for ourselves. So I apologize, but I'm reluctant to really say much more than that. Each person has to look in their own circumstances, guided by their own ideas, and to just find hedges and areas where they can park their wealth, their savings, their assets in ways that will seem less to be touched by either government directly or the volatility of the fluctuations its boom and bust cycle is likely to present. I really would not want to do more than that. And I feel honest in only saying that. Some people say, "Oh, what kind of economist is that? He doesn't tell me, what's going to happen tomorrow." In one sense, I'm in the tradition of Milton Friedman, the Chicago economist, who, when asked one time, "What do you think is going to happen to interest rates?" his reply was, "They probably will fluctuate." And or a grain of truth that you can say about that.
No, definitely. And we really appreciate your insights in all of this, Dr. Ebeling. So before we let you go, did you want to share with the viewers any last thoughts you had and where people can find your work online?
Thank you. Well, I would just like to say is that economics is important for a variety of reasons. It helps us to have a pair of glasses, if it's a rightly constructed economics, that enables us to understand how the world looks and works. And the pair of glasses that one puts on obviously influences how things look in focus and how close to reality they are. And I would recommend to those people who have listened to me and said, "Oh, okay, maybe that sounds kind of like sense." If I can now be immodest, I have an ebook which you can get on Amazon for I think $2.99, called Austrian Economics and Public Policy, Restoring Freedom and Prosperity, in which I explain the core ideas of the Austrian school and their application to various policies, particularly in criticizing existing policies. And more specifically on what we've talked about today, I have another ebook, which you can get on Amazon. I think that one is $1.99 or maybe even 99 cents, called Monetary Central Planning in the State. And in that book, I compare this Austrian perspective with Keynesianism and monetarism. And I then, in the second half of the book, discuss government central banking versus the nature and superiority of competitive free banking with monetary freedom. And finally, if I can sort of be allowed to say a bit more about this, is that in terms of reading some of the articles that I regularly do, I have a weekly column, a weekly article that I write, which now appears usually Wednesday, on the website of the American Institute for Economic Research, AIER.org. And just in the search engine, punch in my name, and you'll see the series of articles that I write weekly. And the other source of my articles is the website of the Future of Freedom Foundation, FFF.org. I've worked with them for more decades than I like to admit. And there's a huge cache of articles, past and present. And those are the two places where one can find the whole array of my articles on political issues, economic issues, questions of public policy and the ideals of individual freedom and the free society.
All right. Once again, Dr. Ebeling, thank you so much for joining us today.
My pleasure.